Welcome to the Family Banking Podcast, where you will learn how to use the money you already have to build multi-generational wealth. Listen in now to hear the why and the how of utilizing a privatized banking system that you control. You have nothing to lose and much to gain. Your host, Chuck Laudurante, will share many stories and life hacks that will set you up for success in the years to come. All right, well, let's get it back on. Welcome back to the Family Banking Podcast. I'm Chuck.
I'm John.
All right. So back to the basics. What we're doing, we're using a unique financial vehicle called a high cash value whole life insurance policy.
Right.
It's a contract. So let's talk about that a little bit. In a contract, each party has rights. In the contract for life insurance, it's a little bit, we're in your favor because you have the right to a death benefit. They have to guarantee your death benefit.
Right.
You have a right to guaranteed earnings. They have to guarantee the minimal amount of earnings that they promise
in the contract.
In the contract. They guarantee that when a dividend is declared that you will participate in the dividend. So if a dividend's ever declared, you have a right to participate
that dividend
with every other mutual insurance company owner. Because as a policyholder, you're a part owner.
Mm-hmm.
You have a right to borrow money against your cash value, and they give you a guaranteed ceiling cap on that interest rate of 8%. So today they're 5.5% loans right now.
Yeah.
They could go higher, but as they go, usually the loan interest rate for borrowing, equitizing a loan or collateralizing a loan against your own money will run with the 30-year Treasury note, as will the dividend. So as the Treasury notes go up and down, the interest rates on our policy cash values will go up and down, as will the dividend. They track. So the interest rate on loans goes up, eventually the dividend will go up. Sometimes leading, lagging, they kind of lag the market a little bit. They're slow to react, but they will track. I have looked at the data over a 30 or 40-year period. So
interesting.
That proves the point. So here you are. You're guaranteed a death benefit. You're guaranteed growth. You're guaranteed right to the money. You have, in our policies, you have a rider that includes a long-term care policy for nursing home expenses, a critical illness policy, a specified medical illness condition, or a terminal illness where you can pull ahead death benefits significantly tax-free. Imagine you're 75 years old and you have $800,000 worth of cash value, and you get this really weird disease, and you start paying all these medical bills. Well, rather than go bankrupt and lose your home, you can just advance your cash value or part of it, all of it or part of it, your death benefit rather, and spend it tax-free.
Wow.
Which is pretty nice.
That
So long-term care insurance, LTC, is pretty expensive. I know you've studied the insurance licensing, John.
Right.
But a lot of people sell those, and there's high profit in those to the agent. We don't do that. We're looking at including that as a rider. It's included in every policy that we put together. So, so infinite banking concept, many uses, the idea of banking, it is a concept. It is a process. Everybody banks.
How you handle your money is a
money's going to flow in. It's right. Money flows into your life. It's going to flow out of your life. And so back, I think, in our first episode, I said, if I could show you a way to possibly most of the money, if we structured it right, most of the money flowing through your life for the rest of your life, you would earn money on that money.
Right.
Almost guaranteed. I mean, guaranteed as far as we can finance this thing, because there is a degree where you can only buy so much death benefit based on your income. But let's say you're making an income and we can insure you to the max level. How would you like to, without earning any more money, just a change in how you flow the money to where it goes and how you use it, make money on all that money tax deferred, and eventually tax free for the rest of your life? Who wouldn't want to do that?
Right.
Because it's a win. It's a win for the average guy as long as you're healthy enough and you have some income and you can afford to make a payment. And if you get into trouble, we have these scheduled payments. We mentioned just the number of 500. We like to go usually for about $300 to $400 a month is what we encourage people to look at. If they can go higher, that's great.
Right.
But that is just the scheduled amount. That's the planned savings amount. It'd be like a forced psychological savings, but there is a minimum payment. You can pay usually about half of that as your minimum payment. So there's some flexibility.
So I think the biggest thing with the thinking about whole life and policies and loans, and the neat thing about it is it has a lot of flexibility. Even though a lot of people will say, "Oh my, I can't imagine you paying this much," or "It doesn't make sense. I can get term for pennies on the dollar," or whatever.
Sure.
You maybe it is maybe $500 to a lot of people that's a lot of money, and I think it is to me as well. But knowing that you can, if you have a tough couple months, you can shrink that monthly payment just to get by if you need that extra $400 or whatever.
You can also pay your premium for the whole next year by taking a policy
you have one good month, then pay it all and get it over with, and that's good too.
But once you get going, if you have $20,000 or $30,000 of cash value, which is not uncommon,
right?
You started yours with, I think, 20 or 23, and then you paid by the month.
Right.
You have all that $20,000, $30,000 sitting there. And if you have a bad year or a weak month or weak 6 months, you could just borrow against your own money, defer the payment for a year or two, pay the next year's premium, keep your policy in force. You never lose this policy. You never. In fact, as you get older, the premiums go down for some mechanics inside the policy that are designed in there. And eventually you could wind up in your 70s still paying premium. I'm paying premium.
Right.
And, that premium would be a lot less than when you're in your 30s. But the multiplier is huge. Some policies get 4 to 5 to 6 to 7 times the money. So in other words, I'm 70. If I put in $1,500 premium, I'm going to get $7,500 in growth in my policy because of all the compounding that's taking place
over the course of the other money.
So my money's going to grow as I pay that premium. And the result of the increase over that year is going to be so much. Literally, by staying in the game and paying that premium, I'm getting 5 times the money that I just spent.
You just spent.
So if I knew, and I'm 70 years old, and let's say I'm out of work, but yet I have this policy and I need $1,500, who wouldn't loan me $1,500 if I say I'm going to get 5 times the money and I'll give you 1 times that? I'll pay you back as soon as we put the money in. I'll take a policy loan and give you your $1,500 back.
Huh? Yeah.
Because I'm going to have 4 more times. I'm going to have $6,000.
You're just talking about for the gain that you get by just even keeping the policy in check, so to speak. You're going to make money.
Imagine if I put $1,500 in and I got $7,500
back. Yeah.
I could go borrow 15 of the $7,500, have $6,000 for me, pay my guy off, bingo.
Right.
I'll pay back the $6,000 whenever. Some people never pay later in life. They never pay back their policy loans because they have enough built-up cash value that when they die, the death benefit will pay off the loan.
I got you. Yeah.
So let's go over that. I know there'll be a lot of questions about what is whole life insurance.
Right.
You can get a hold of me, banking at privatefamilybanking.com. John will be working with me soon. He'll be fielding questions. Yeah. And we will be glad to get a one-on-one call going and go over these things in detail. But so let's recap. So we talked about living benefits versus a death benefit. Everybody knows in life insurance what a death benefit is.
Right. When you die, a beneficiary
somebody gets that
benefit.
Money tax-free. And if you buy a term policy for $1 million and you die at age 53, that's probably a pretty good use of the money. But not everybody dies that young. So eventually, if you bought it in your 20s, by the time you're 53, you probably don't have a policy. You got to get another term policy. And as you get older, term policies get more expensive. Mm-hmm. So the sooner you can get a whole life or permanent insurance policy, the better.
Right.
Because
the earlier
you
the
can
better.
Get millions of dollars.
It's cheaper especially when you start applying the whole compounding thing and all that.
Absolutely.
It's already.
Kind of a money machine. So kind of recapping, what are the living benefits? Well, first, as I mentioned, you could pay off debt. You could take the Dave Ramsey, what do they call it, debt snowball approach.
Right.
But use the banking policy, fund the policy. Here's the money movement. Paycheck, checking account, banking system.
Right.
Out of the banking system, a loan.
Right.
Put the loan to the credit card company. Boom, pay that one off. Cycle. Get rid of the credit card company. Even if it's a 10% loan, some of my clients that come to me and we get them out of debt, they're paying 29% interest. Ridiculous.
Right.
We pay those credit cards off and recapture all of that money, throw it back into the policy, and pretty soon this thing's going like a turbine. It's just spinning like crazy and gathering speed because they're getting out of debt, capturing that in the interest, even though they're borrowing against their own money. They're paying part of that interest is coming back to them in cash. whereas they were giving it all away to the
Right.
credit
Yeah.
card.
You know, if they're taking, I don't know, like let's say in a real practical example, they take a loan out, or they take that paycheck, put it into the policy. They get a loan out at 5% or whatever they are right now. They take that same money, the exact amount if you want, and then pay the credit card off,
Chunk
which is
it down.
10%. But you also have to keep in mind that that policy is building, compounding,
That's
building annually over that money,
Mm-hmm.
you know, at 3% or whatever it is. So you're really
Plus
only getting a
dividend.
loan
Yeah.
theoretically, I guess, for maybe 2%,
Mm-hmm.
whereas it would have been 10.
Mm-hmm.
So
Yeah.
So really, it's not really necessarily. It's just a smarter use of money. Somebody's got to pay the piper.
That's
So
right.
it's just a smarter use of using
It's
that money.
getting control of your money.
In control.
Too. Yeah.
Mhm.
Yeah. Don't let
Yeah.
the banks have control. So that's one. The other is, you mentioned it, making loans to do purchases. So you
Right.
you actually wound up buying a truck through your policy, right?
Yeah.
A pretty nice truck. A
Yeah,
diesel truck,
works.
a big truck, a work truck.
Starts. Yeah.
Yeah.
And so that's a good point. You can buy vehicles maybe. I think a good, while using your policies compared to what, you know, I think you've definitely mentioned that to me. You know, if you're not going to invest it in a business venture or you know, I don't know, property or whatever that's going to make you money, then maybe it is better to just get a lower interest rate and pay yourself, so to speak.
Right.
And
Right.
so that's an option. What other options? What other benefits do you get?
So
with
some
this?
more living benefits would be, you could do stock market investing. You
Yeah.
could do some kind of trading account. I mean, I think you need to be selective. You could do Bitcoin. You could do
Right.
gold. You could do silver. You could do stocks. You could also do real estate. I mean, that's what I'm doing with mine. I'm building a rental real estate,
Right.
a rental property.
Right.
And I'm getting rents to pay back the loan that I took to build the property. We financed
Right.
the entire transaction ourselves.
Right.
You know, well over $200,000. So
Right.
that's pretty
That's
cool.
a substantial amount.
And you
yeah.
don't have to go to the bank, and you don't have to
Right.
pay any late fees, and you don't have to show up with 500 pieces of paper and your firstborn. And,
Right.
You know, every dollar you ever made and every credit card you ever had.
Right.
Wait, and get closing costs and all of that.
Yeah.
So that's another thing. And then the fourth item is, you could do it to as a retirement supplement. You could use your banking system either through the loan, collateralized loan, or you could do withdrawals later in life up to the basis. You could withdraw without taxation. Eventually, you might run into some taxes, but it kind of defeats the long-term purpose when you do that. But
You pull from
you
the
could
cash value.
You could pull dividends out
Oh, okay.
later in life.
Uh-huh.
Just take cash dividends.
And don't take a loan.
What we do is, or reinvest them. Today, we structure the policy so those dividends are automatically reinvested. You could ask for a cash distribution
Okay.
when you're in your 60s or 70s.
Huh.
Use it to supplement your retirement.
Right.
But again, you might trigger some tax things later on in life if you did that.
Right.
So those are sort of the living benefits. And then, of course, there's the death benefit, which we'll call the legacy benefit.
Right.
Where, I mean, it's not uncommon for some of my clients to have $4 or $5 million of death benefit,
Right.
and they die in their 70s, and their estate winds up getting, or their kids or their grandkids, however they divvy it up. That is an amazing start. Now, you want to train your kids, so we're going to talk about multi-generational, the family banking part. We're going to focus on the next episode. And we're going to talk about, how do you have a family office? How do you structure? I'm working with several families doing that now. Some are very, very structured, and we've actually got them in a coaching program and a training program, very detailed. Some we're just kind of guiding gently, no charge, and we're just saying, okay, yeah, you're going to want to write a little charter. You're going to put some rules in place. This sort of goes after the Rockefellers and the Rothschilds, and where they had family banks where you had responsibilities to return a gain back to the family bank. So much like charging interest, you were responsible. When you borrowed money from the family bank, you had to return it with a gain.
Huh.
Yeah.
So it might not be interest, it'd just be a gain.
A gain.
It'd be like,
you could say it's just a fee for using the money, but it was a family money. And you had to make it successful. So they wanted people to grow the family bank for generations to come. So they self-finance. Now, here we're using a life insurance company that has a large platform that we can use and leverage all of the things that life insurance company, mutual life insurance company, knows what to do with our money. they're investing in very high return assets and very conservative, and they have a lot of money in cash reserves to pay death benefits.
Right.
They're required to do that by law, where the banks are not. You know, the FDIC is almost insolvent, by the way. People say, well, I've got the FDIC. Well, maybe you don't. We'll find out if they have a real bank run coming up.
Interesting.
So I think that covers the waterfront. I think in the next episode, we're going to cover the idea of the whole idea of family banking. And we're going to talk about legacy planning and how do you think this thing through? How do you engage with your kids? How do you train your kids about money?
Right.
You know, teach them about fractional reserve banking. What is that? That means that banks can loan out multiple times the money you put in. Teach them that a bank deposit is a contract where you're lending, basically. It's not a contract, rather. You're assigning the title to your money to the bank. You're actually loaning your money to the bank when you make a checking account deposit. A lot of people don't know that.
Yeah.
You know, what is the real cost of interest and taxation? Taxation is an insidious thing, income tax. And if you can, the more income taxes you can avoid on gains, it's a huge multiplier over the long run. So those are some of the things we're going to cover.
Yeah.
I'm glad that you
Thanks
all
for watching.
Came and watched. And
keep on watching.
I want you to, you know, these are going to be short and sweet, but very informative and practical. So, John, just before we close, tell them a little bit of when you got started.
Right.
You were 23. You put some money in a policy, and you went out and you did what? You bought a
I think I had the policy for maybe a year before using it, or maybe 6 months. I can't remember. We put in, you know, started it out, put in about 20,000 or so into the cash value. And obviously,
you
making
put that money in, not money you had already made,
had earned somewhere else.
Building trades, right?
Yep. So I took that, put that in there, and then I bought a piece of property, took a loan against the policy, and kept on paying the premiums. Then I bought the land, and then about another year later, I think I owned it for about a year. We went to the bank, got a new construction loan.
And
that took about a year.
Saw you as owning that cash free.
Yeah, no loans or they don't, because the loan to the life insurance is private.
And it doesn't count against your
credit score. So the bank didn't have any problems because there's no liens or whatever, you know, against the property for having a loan against it or anything.
Because your lien was against your cash value, in that sense,
and so that's protected.
Not against the property.
The insurance company knows they got your money already. So if you welch, they got it.
And the bank didn't see you. They saw you as an owner, title clear.
Cash and clear.
There's no lien on the property,
free and clear, so to speak.
Yep.
So, anyways, built the house and then sold it.
Right at the peak.
At the peak, yep. So then we sold that, and I was able to pay back the loan, and some from the proceeds of the property, and put more cash value into the policy. So now that cash is earning more, and then since then I've used some of that money to buy a work truck, and so far that's going pretty well. So that's nice. And again, you have control of the money, and you get a lower interest rate, and you're making money on that money I've made on that house will always be being used
for the rest of
my life. But because I bought that work truck, doesn't mean I lost the use of the original bucket, so to speak, of money. So that's where value
people,
is.
They've got to grab that. Once they grab that, then all of a sudden they're going like, why wouldn't I do this? Like I'm getting basically. So when you take a loan, the insurance company's giving you, if you have $50,000 in there, you take a $50,000 loan, you now have $100,000
earning
in play. You have $50,000 earning, then you have $50,000 doing whatever it was, either avoiding a payment from a loan from a credit union for the truck, or maybe you put it in an investment that's
also earning money as well.
Yeah, so we call that earning money inside the policy and outside the policy at the same time, with the same money, but in two places.
Where the value for this is that you're never losing your cash to the truck dealer or whatever, and so you will actually not lose the value of that dollar earning you money. It will always. It's not a substantial amount. Like it's not doubling in dollar amount necessarily. Maybe right now,
but it's steady
continually.
Compound.
Because once I bought that truck, if I bought it cash, I would never see that $50,000 again if I sold the truck, I might get something close to it a little bit if I sell it quickly after I bought it. But over time, I've kind of lost that dollar amount. I'll never see it again. But if I use the policy, I'll still always earn that money on that original dollar that I put in.
Yeah. King at privatefamilybanking.com.
Yeah.
That's the way to get a hold of me. Banking at privatefamilybanking.com.
Awesome. Give them a call. Give them an email. We'll see you next time.
All right.
Thanks for watching.